we're going to do something a little bit different here in this video. And there's going to be something that we need to be aware of before ever placing an options trade. Now, we're going to look at how option prices are kind of created and what they're made up of, more or less kind of the anatomy of an option in this video, but we're going to do it in a very simplistic way. This is going to be a pithy high level overview here of options pricing. If you guys want to dig deeper and get into more detail of options basics or options Greeks, check out our other videos where we go into more detail about how those are created and the overall Black-Scholes model. So in this video, though, we're just going to kind of chalk it up to kind of a basic little checklist of what to look for before actually placing an options trade. And it's all going to be about our options pricing and what the option is actually made of and what it contains. So there's going to be the first thing that we're going to look at more placing an options trade is going to be, is our option going to be trading in the money or out of the money? That is the main thing to look at first. So for calls, your in the money options are going to be any strike price that is less than the overall stock price. So for Tesla, let's just say it's trading at 351, 350 and below, those strikes, those are going to be considered in the money. Whereas on the other side, the puts, let's say Tesla is still trading at 351. This strike price right here, 352.5 and above, anything above 351, those are going to be in the money for the puts. So it's complete opposite if you're looking at puts or calls, right? And then for out of the money, for your calls, anything above that stock price, any strike that is coming above that stock price, that is going to be considered out of the money. And then the puts, anything that is below the stock price, that is going to be considered out of the money for the puts. Now, the reason that it's good to know if your option is going to be in the money or out of the money before you're placing a trade is because in the money actually contains something extra that out of the money options do not. So the in the money options are going to contain intrinsic value. So intrinsic value means, let's just say again, our example here in Tesla 351, our 350 strike right here, it has $1 of intrinsic value. So it's just 351 and then you subtract 350 from it, $1. So the actual intrinsic value of this option is going to be $1. Likewise, if we go to 345, we are $6 in the money. So we have $6 of intrinsic value into this option. So if you look right here, this 350, we just said it's $1, right? So really at 4 o'clock, all things being equal on August 21st, this call is going to be worth $1. But look at the price right now. It's trading for $5.70. That's because it not only contains intrinsic value, it contains extrinsic value as well. So your in the money options are going to contain both intrinsic and extrinsic value. Out of the money options here, so you can see this strike and beyond to the call side, right here to the puts and down, those are going to contain only extrinsic value, and those are out of the money options. Now, what is extrinsic value made up of? Well, it's more complicated than intrinsic value. Intrinsic value is really easy, right? So you just find your stock price, or you find your stock price and then you kind of subtract your option price if you're in the money, and then bam, there's your intrinsic value. But out of the money actually contains only extrinsic value, and it's made up of multiple things, right? So extrinsic value is we're going to chalk it up to just two main things in here, right? So it's going to be time and it's going to be volatility. So it's going to be your theta and your vega. It's going to be how much longer until expiration, and then it's going to contain speculation as well. So those are the two main things that extrinsic value is made up out of. Now, for your in the money options, all the way up until 4 o'clock at expiration, you are going to have intrinsic and extrinsic value. So right here, we have $1 of intrinsic value for that 350 call on August 21st, but we also have $4.70 of extrinsic value on top of that. So that's going to contain your time, that's going to contain your volatility and all your speculation, right? So it's always good to know before you're getting into a trade, are you in the money? Are you out of the money? How much volatility is packed in here? How much theta is packed in here? Where are my deltas? Things like that, right? And it all has to do with your intrinsic and extrinsic value. Now, most traders, most retail traders, they're going to buy out of the money because it's cheaper, right? So they're betting on the stock price to rise, but they also have to buy or I guess when they're doing that, what they're buying is they're buying time and they're buying speculation. Whereas if you're buying at the money, or I'm sorry, you're buying in the money or deep in the money, then you are also buying that extrinsic value and you're buying that higher delta. Same with the puts right here, right? So you're betting for the stock price to go down, you're buying speculation and you're buying time. The shorter the time you have left, the less theta you're going to have, and overall probably the less volatility you're going to have in your option, depending on how far you go out. And then also likewise, the longer you go out in expiration, the more time you're going to be paying for, and most likely more volatility as well. So that is some things that you need to know and be aware of when you're trading and before you're kind of placing an overall option trade where they're just buying or selling a call or buying or selling a put, right? So it's always good to know that as well. Also, we have to worry about our skew. So we care about in the money, out of the money. We care about intrinsic and extrinsic value, which contains our speculation and our time. But the last thing we're going to worry about is our overall skew of the options. And that is going to be what is trading richer. So what is going to be trading more, the calls or the puts? An easy way to do this is you're going to go about $10 out of the money here and $10 out of the money or in the money on this side. And you're going to look at your calls as compared to your puts. So we're trading about 351. We'll go to the 360 strike here. We're trading at about 198 and your delta is sitting at 23. Likewise, if we go down here at about 340 on the put side, your ask is now trading at 124 and your delta is sitting here at 20. So your delta is a little bit less. Your ask is less as well, and you are paying more for your calls. So in this situation for your August 21st Tesla expiration, you're going to say, hey, this has call skew in it. Now, each expiration is going to be different. So the closer you get to your expiration, it's supposed to even out, but also it depends on the volatility of the underlying as well. And likewise, the further you go out, it might expand to the call side or it might expand to the put side. A normalized skew should be your risk is to the downside because everybody wants the protection. So therefore, your puts should be trading for more or they should be trading richer. But in high volatile scenarios and high flying stocks, most likely your skew is going to be to the call side, especially for shorter dated expirations, just because that is where your overall risk is. Your risk is that this stock is just going to fly through the roof at any day now, right? And that is where our skew comes into play. So your skew is always front loaded with time, but it's also front loaded with a lot of volatility as compared to the moneyness of your option and the overall stock price. So I know we got kind of heavy there for a second, but overall, we're going to back this up. Nice 3-point checklist here. You're looking at your in the money or out of the money options. You are looking at the intrinsic and the extrinsic value, which is going to contain your time and your speculation, but you're also looking at the overall skew of your options to see where your risk is. And that last one, it pertains to just buying and selling naked puts and calls because you want to figure out if you're getting ripped off as far as I'm going to pay more for my calls rather than my puts. But if you're also placing spreads, your put spreads in a call skew environment are actually going to trade for more rather than your call spreads in a call spread environment, right? So wherever your richness is or your skew is pointing to, your bell curve is front loaded or the belly of your curve is going to be kind of leaning one way rather than being symmetrical. The opposite side is always going to trade for more in your spreads where your nakeds are actually going to be less. So hopefully that makes sense, but that's always good. It's always a good refresher to just kind of take a step back and look at, oh, okay, all right, yeah, I should be aware of this. Even if you're not really necessarily looking at your Greeks per se, if you're just looking at your ask and going by moneyness, it's always good to know, hey, this is how much intrinsic I have. This is how much extrinsic I have. It looks like these calls are trading for more than the puts on the opposite side, and kind of giving you an overall idea of how everybody is thinking about this stock and this underlying and these derivatives underneath the security, rather than just blindly going in and picking, hey, I want this thing to go up and I want it to go up to 360 by Friday. Boom, I'm buying that. Well, you don't necessarily want to do that because it's going to pack in a lot of time, a lot of speculation that you may or may not want to carry on, or you do want to carry that, but you would like to carry a little bit of intrinsic value just to kind of hopefully, if you do get a nice win in there, you're probably a profit is going to go up with it. So that is what we're looking at overall here for our nice pithy kind of short video of the anatomy of an options trade and what to look for before placing a trade. And hopefully that helps you guys. Again, if you want to dive in deeper, we have other videos where we dig into delta, theta, all your Greeks, volume, bid ask spread, things like that, arbitrage, all of that you can find on our channel here on YouTube. But until then, let's see what happens in here in the overall markets. And as we're playing tomorrow, and as we're going throughout the rest of the weekend here, let's see if we can be aware of our overall in the money and out of the money options and look for our skews in here to see how much time and speculation is going to be loaded into every one of our options that we are playing here going forward. All right, guys, if you like this video, make sure to check us out on all of our social media. We also have a Discord service if you are interested, and you can find all of our socials in the description below.